All right, everyone. Thanks for joining me. This is Michael Carroll for the exam number 3 review for Business 201, Intro to Accounting. So we'll jump right into it. The format of my study guide is a little bit different this time. It's mostly multiple choice. So number 1. So we've got a company that is paying its employees $50,000 in salaries. And we've got the following information. We've got FICA, state unemployment, federal income, state income, and federal unemployment taxes. In these kinds of problems, we've got two journal entries. The first one is a journal entry related to the employees. The second journal entry is related to the employer. So whenever we make a journal entry to pay employees, it's always wages expense as a debit, and we have wages payable or salaries payable as a credit. That's our normal journal entry. Now in this case, we've also got some FICA, some federal income taxes as well. Our wages expense is going to be the amounts that we pay the employees, or the full amount that we owe our employees, $50,000. But they're not going to get $50,000 as wages. As we all know, when we work, we may get $50,000 as income, but after taxes, we get less than $50,000. So we owe $3,825 in FICA, or our Social Security. So it's going to be FICA payable for $3,825. As a credit, we've got the state unemployment tax. That does not relate to the employee. When you get wages when you work, you're not paying unemployment taxes. That's the employer. The employer pays unemployment tax. So we'll skip that one. We'll go on to federal income taxes. The employee pays federal income taxes. So federal income tax, FIT payable for $3,000. On to the next one, we've got state income taxes. The employee pays state income taxes, so we will put that down. State income taxes payable. We're going to take that out of the employee's wages, and that's it. So the employee does not pay unemployment taxes on the federal level as well. So that's all we got. Take our debits minus our credits to find this plug. And our wages payable is $31,875. So just to say again, this is related to the employee. Now the employer has another journal entry. We're going to debit payroll expense, or payroll tax expense. And then we're going to credit all the other taxes that the employer pays. So the employer will pay this FICA tax, FICA payable. As you should notice, both the employee and the employer pay FICA. So we're going to credit that for $3,825. The employer does not pay, they do pay state unemployment tax. State unemployment tax payable for $150, and they also pay the federal unemployment tax. Federal unemployment tax payable for $400. So there's our credits. Add those all up, and that should equal our debit of $3,825 plus $4,375 as our debit. Make sure I got that right. $4,375. So there's our two journal entries for this problem. Now the problem only asks for determine what is the net pay, or the net cash to be received by employees. This is the net amount that the employees will receive, $38,175. All right, moving on to number 2, we've got a question. Making a bond callable means, we'll go through each one. The bond does not have to be repaid. That is absolutely false. The bond always has to be paid. B, the issuer can redeem the bond earlier and avoid future interest payments. That's correct. That's exactly what callable means. They don't have to wait until the end of the maturity. The company can just buy back the bond whenever they want. Letter C, the bond has assets pledged as collateral that can be called upon to satisfy the debt. That is not a callable bond. That is a collateralized bond. The investor can call and convert the bond to equity. That may seem like a callable bond, but that is not a callable bond. A callable bond is, as we said, the company can redeem the bond. Letter D is saying the investor can call the bond. That is a convertible bond. All right, number 3, we've got a company that issues 7% bonds, 30-year maturity, and a $50,000 bond. The market rate at issuance is 6%. Which of the following is true? So this is probably going to be asking about the price of the bond, looking at the market, or comparing the market rate to the stated rate. So automatically, since the stated rate is higher than the market rate, we can conclude that this bond is going to be sold at a premium. A good way to think about it is this bond offers a 7% return. The market, all the bonds out on the market, give you about a return of 6%. So if this bond in particular gives you a higher return than anything else you can find on the market, people are going to flock to this bond. Therefore, the demand for this bond is going to go up. Therefore, it's going to increase the price of the bond. So this is a really good bond. They give you a really good return. Therefore, we're willing to pay more money for it. Thus, a premium. So we're going to pay, maybe $51,000, $52,000. So let's look at the answers. A, the issuer received face value in cash at issuance. Automatically, we know that's false because this is either we know it's a premium bond, so the issuer does not receive the face value in cash. They're going to receive more than the face value. The face value is the $50,000 and records a discount. That doesn't make sense at all. The issuer receives less than the face value. We know that's wrong because we know this is a premium, so they record a premium. That's absolutely false. The issuer receives more than the face value in cash at issuance. That is true. The company is going to receive more cash because they're selling it at a premium. But as we continue reading, it says they record a discount, which is false. We would record a premium. And therefore, D is the correct answer. They receive more than the face value in cash at issuance. Therefore, they record a premium. That is correct. Moving on to number 4. We've got a company that issues a $100,000 bond, 10-year maturity, 2% stated rate, and annual interest payments. Assume the issuance resulted in a $3,000 discount on the bond and will be amortized on a straight line basis. What is the carrying value of the bond at the end of year 4? So there's multiple ways you can go about this. One, you can create an amortization table. Now, on the exam, they're not going to make you do an amortization table. But we'll go through all the different ways you can do it. So we'll go through actually all the journal entries that relate to this problem. So the first journal entry we make is going to be the issuance of the bond. When we issue a bond, that creates a bond payable. We're going to credit bond payable for the face value of the bond, which is $100,000. We are also going to debit cash because we're going to we're issuing the bond. People are buying the bond from us, therefore we're going to receive cash. But we're not going to get cash of $100,000. We're going to get cash of, well, we've got a $3,000 discount. Therefore, the bond is $100, but we're selling it at a $3,000 discount. We're getting $97,000 cash. And then we've got a discount. We're going to credit the discount on the bond payable for $3,000. Discounts are debited. Premiums are credited. So there's the first journal entry we would make on the issuance of the bond. At the end of the year, we're going to record interest. So we always record interest expense as a debit, and if we pay cash, we're going to credit cash. To figure out how much cash we pay, we take the stated rate, 2%, times the face value of the bond. 2% of $100,000 is $2,000. We're paying cash of $2,000 for this year. We're also going to amortize this discount. We're going to decrease this discount using straight lines. So 3,000 divided by the maturity of the bond, so 10 years. 3,000 divided by 10, that equals 300. We're going to credit the discount by 300. And then our interest expenses are plug. Whatever those two add up to is our interest expense. So we make this journal entry every year, or at the end of every year for 10 years. So, now we'll keep going. So, we do this every year. After year 1, year 2, year 3, yada, yada, yada. At year 10, at the end of the 10th year, we make this same journal entry. We also get rid of the bond payable. To do that, or the journal entry for that, is a debit to bonds payable for the face value, $100,000, as we originally recorded. And we're going to credit cash for $100,000. You should realize that there's nothing going on with the discount because over the 10 years, we've slowly been decreasing the discount. And at this point in time, at year 10, our discount is 0. So we don't have to worry about the discount anymore. So there's the 3 big journal entries. The question's asking, what's the carrying value of the bond at the end of year 4? Well, if this is year 1, at the end of year 1, when we make this first journal entry, the bond payable is recorded at 100. We had a $3,000 discount, so therefore, when we set up the bond's carrying value was $97,000, but at the end of the first year, we decreased the discount by 300. Or in other words, we increased the value of the bond by 300. So at the end of year 1, the bond's carrying value was $97,300. At the end of year 2, the bond's carrying value was $97,600, and you can see it from there. Year 3, it was $97,900, and then year 4, it would be $98,200. A. A is our answer. Okay, moving on to number 5, we've got an amortization table. Blah, blah, blah. You don't need any of that information because it's all right here. So we've got a $10,000 bonds with a maturity date of 5 years or 5 periods. We've got a cash payment of $400. The stated rates, we can do the math, looks like it'd be 4%, which is 400 divided by 10. 10,000, which is 4%. but you don't really need to know that. And our amortization, oh, this is, I think I changed this up for you guys. I think I had the premium at 10,500 instead of this number. I think I changed it for you guys. So our amortization would be, I believe I put it as 100, and therefore our interest expense would be $300 every year. So we'll go with what you guys have. So just ignore these numbers for now. So the question's asking, perform the cash interest payment journal entry for period 4. Well, if we look back, they're asking literally for this journal entry, the cash payment of interest. We make this journal entry every year, and they're asking for the journal entry in year 4.